clearly significant. We've had a massive repricing in the oil market, I'd just say, over the last couple of weeks. I think the market's really sort of moved from this sort of being overly optimistic that we get some sort of resolution in the Persian Gulf to now one where there's sort of no signal for sort of a resolution, right? And clearly the market's repricing that. Not just repricing sort of a continued blockage of flows through the Strait of Hormuz, but also the potential for escalation, re-escalation, right? And what that means for again, not just oil supplies through the Persian Gulf, but also from the Red Sea.
Yes. What do you think markets are pricing in about the expectation for the duration of this war? There had been really baked in optimism that because the market, was expecting some resolution to come swiftly, that would indeed happen. What do you think markets are thinking now about duration as we're in the third month of the war?
Yeah, I mean, we've revised higher out forecasts just earlier this week. We had been maybe sort of more in the optimistic camp, thinking that we would get some sort of resumption in flows, at least gradually, sort of through April or the end of April. Clearly not happening. So our sort of new base case now is that we'll see a gradual resumption through May and June, but still remaining essentially below pre-war levels for much of the year. And under that sort of scenario, we're looking at an average of $104 for Brent over the second quarter. Clearly looking at where the front month futures are trading at the moment. Clearly the market's maybe not that optimistic at the moment, and probably pricing in something that's sort of more of a sort of essentially a full closure pretty much through till the end of May, I would say.
What level of demand destruction do you get with oil prices at $104 a barrel?
Yeah, so up until now, I mean, we've been estimating that we have demand destruction in the region of about 1.6 million barrels a day. We're estimating that we need to see potentially fill a shortfall as much as 9 million barrels a day. So clearly, there's still plenty of scope for more demand destruction, and clearly these price levels are going to sort of ensure that we do see some more of that. But the big issue is if we really want to sort of fill that full shortfall through demand destruction, we're going to actually have to see even higher prices.
The US is exporting oil and energy. Can it continue to do so? I mean, it's importing some other grades of oil from Latin America, as we heard from our EME News director, Will Kennedy, only earlier this morning. But how much can the US's exports fill any of the shortfall?
I mean, it certainly helps the market, right? I mean, we look at the last few weeks, we've seen sort of back-to-back record exports, whether it's on the crude side or refined products side. So certainly that is helping the market to a certain extent. But again, right, I mean, we're losing, in terms of flows, about 13 million barrels a day of supply. The US exported a little over 6 million barrels a day of crude oil last week. So, the potential to increase that drastically to fill that shortfall is really not there. And then also just from a production point of view, we're not really seeing any signs of a big ramp up in US oil production. So if you look at the rig count activity from the US, it's been largely flat over the last couple of months, suggesting that we're not going to see any imminent increase in US crude oil output, at least not this year. I think any supply growth that we do see coming through from the US is probably going to be more of a 2027 story. So a bit too late, but also the volumes are not going to be that significant. I would say at most you'll see is probably about 500,000 barrels a day of supply growth coming through from the US. So again, not going to fill that gap.
How then well positioned is China to be, I suppose, to survive or to cope with this record oil price shock?
Look, I mean, I think Asia, obviously as a whole, is clearly quite exposed to what's going on in the Persian Gulf. More basically 80% of Persian Gulf flows or more that go from the Persian Gulf go into Asia. Now, over the years, we have seen China insulate itself quite well from any sort of these supply shocks. They've been building up inventory pretty well and significant rates over the last several years. Earlier this week, you had refiners essentially calling on the government to allow for the export of refined products once again, because the stock levels when it comes to refined products, gasoline and diesel, are actually very comfortable. So I think from that perspective, China is actually quite well insulated relative to some of the other countries.
Yeah, the largest oil and gas company in China reported by Bloomberg saying that they would make every effort to ensure that there are no domestic shortages. That's China's National Petroleum Corporation. Just thinking more broadly about the commodities complex, crop prices are rising. We've seen farm commodity prices hitting a 2-year high this week. Food packaging costs are also increasing. How much do you think about that side of the commodities complex?
Yeah, absolutely. Input costs for farmers are certainly increasing, right? Whether that's going to be your diesel costs for tractors and transportation, and also just fertilizer application, right? Fertilizer costs are going up significantly, and that's just sort of as we go into the spring planting season in the Northern Hemisphere. So certainly that's going to raise input costs. It's also going to raise concerns over yields. If you start seeing farmers reducing the amount of fertilizers they apply to crops. So clearly that does leave upside to food prices, and clearly we're starting to see that feed through in some of the in some of those grain prices.